Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, June 28, 2017. Looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Obviously, you know today, and you can see today was a pretty decent up day. The SPDR was up over $2, almost 1%. It was a take back from the debacle from yesterday. And this is what I was talking about. So we shimmied down as it stands with the SPDR close to the 240.75, but not really close enough. It was interesting. The low yesterday was 241.31. However, and we've read this book before, the S&P futures, the S&P E-mini futures contract, for example, overnight did come down towards that level. So I'll do some math with you and we'll go over the numbers just for fun. So here's the S&P E-mini contract, and it is, I'll bring up the continuous contract, and you can see here on the daily chart, let me just move this over. On the daily chart, you can see where the low was 24.1375. That actually happened, I think, around 4 o'clock in the morning. Let me just double check. So if we bring over the 10-minute chart, you can see here that at 4:30 in the morning, the low was 24.1375. If you do the math, and basically the way it works is each 10 points in the ES contract equals 1 point in the SPY. So doing the math, as you compare the ES to the SPY, that makes the low that was hit in the overnight session in the futures contract equivalent in the SPDR to 241.11, 241.10, in that neighborhood. We'll call it just north of 241. And remember, what we said over the last few days is anything at 240.75, give or take 25 cents, is basically a hit. And that's what we were looking for. So as it turns out, the S&P or the SPDR came down into the support level we were looking for the pullback, keeping the bullish pattern intact. We essentially came in to recheck or retest, check in at the breakout point, which is over here, pierce through it by a little bit, and then today we had the up day. So now what my belief is that we're poised, and it's not going to all happen at once, although it can, but it generally doesn't, that we will make it to new highs once again. And that is precisely what we were looking for, leading up into what I believe will be a cycle top in about anywhere from 3 weeks to 6 weeks out. That's the window we'll give it. We're in the beginning stages of the window, but as you can see, each and every time the market has a little bit of a downdraft, it gets saved and we go back higher. And what that is the cycle that's topping out, pulling the market up into the cycle top. It's nothing more, nothing less than that. I've seen it for years and years and years happen on the upside, and I've seen it happen on the downside. The cycle culmination will pull the market into the ending or culmination of a cycle top or bottom. So the next question is, what is the upside target if we should continue up and make new highs? Well, frankly, it's really not that far away, and it's not that far from the old all-time high. And the number that I come up with is 245.40. Maybe it's 245.50 or 75, but I think we get to roughly 245.5, and that should happen within the next couple of weeks, if not sooner. Now, there is a little bit of a wild card in terms of time, and because we're coming into the 4th of July or Independence Day holiday, which is, I believe, next Tuesday, markets have a tendency around holiday weekends, and while this isn't necessarily a holiday weekend, it's kind of close because you have a lot of traders, and I mentioned this the other day, you have a lot of traders, investors, Wall Street participants that will basically take this Friday off, maybe even Thursday, go away for the weekend, they go out to the Hamptons or what have you up in New York, and they'll probably not come back to work until Wednesday, maybe even Thursday. that should promote light volume across the markets really beginning now. And there was light volume even today. On the big up day we had, we didn't have, specifically institutional participation on the upside. We only had about 68 million shares on the upside, 69 million shares when the market was up, and that's still below the 90-day average. So it wasn't like everybody was rushing to buy the market across the board. It was just a take back from yesterday, and that really relates back to, the culmination of the cycle top and how the markets just get pulled up into it. So the fact that we're in and around a holiday period coming into a weekend, I would not be surprised to see the market get a lift. And if it gets a lift, buying begets buying. You could absolutely see. Now, I'm not forecasting this. I'm saying it's certainly possible. In fact, I think you actually have a better than 50-50 shot of this happening, that you could see the market reach the numbers we just mentioned, which is 245.50, give or take. You could see that happen, by the 4th of July. It could happen on Friday. It could happen on Monday. It absolutely can happen sooner than later. So just as a short recap, what we have here was a bullish pattern, pullback into the level, and here we go. And that's what it looks like to me. That's what we've been discussing. That's what I've been forecasting. And that, in my opinion, appears to be what's happening. Next up is the IWM. And obviously we had a nice up day in the IWM, leading the markets today. It was up 1.5% against the spider up less than 1%. So certainly a leading indicator, certainly the leading indication on the upside today. And what we discussed yesterday is that we had a bullish pattern, and that as long as we did not close below 138.74, that's this line here, that held the bullish pattern intact, and that as long as that didn't happen, we were poised to go higher. That's what's happening now. We'll probably make new highs in the IWM. However, whether or not we close above this trend line by the close of June remains to be seen. It's unlikely. It could happen, but I don't think they're going to do it. If I had to take a guess, they probably close right on it, although it's possible we're very, very close. Either way, higher prices coming in the S&P, higher prices coming in the IWM. You'll probably have a couple of fake outs to the downside in the interim, but net, higher prices coming. That's what was prescribed. That's what appears to be happening. Same deal with the IWM. The market remains bullish. We're above the moving averages. As long as we stay above on a closing basis, 138.74, nothing wrong with this market, and that's what's happened thus far. Taking a look at the VIX real quick, we had the nice uptick in the VIX yesterday, and today a complete take back on the downside. So we had a reversal of the up move from yesterday. And as long as the market goes higher, we're going to have lower prices in the VIX. When we get into that 9 handle, low 9s, even an 8 handle if you can get it, that's where you want to be looking on the long side of the VIX. That story remains the same. Transports. The line in the sand that we were using on the transports over the last several sessions was this bearish pattern that was developing that would normally play out to the downside, that looked like it was beginning yesterday. But remember yesterday, the transports were not down as much as everything else. We talked about it. I said it was interesting, or at least I thought it was interesting. I'm not sure exactly what I said at this point. That was a long time ago. But what's important is where we closed today. We closed above the red candle high, 94.68.65. We closed over 9,500 today. That's set in stone. This is bullish, above the moving averages. The bearish pattern is wiped off the table. Higher prices are coming. You can see this in all the charts I keep bringing up. It says bullish, bullish, bullish. And you have to go with the trend. The trend is your friend until the very end. There's really not a lot of resistance before we reach double top, which is over 9,600, which is over 100 points on the transports from here. That will be a nice run in the transports. We were up 133 today, 1.4%. That's a tremendous move in the transports. There could be another day or so like that in the cards. If we break above, close above these highs from back here, then that spells obviously more bullish tone for the transports. So we'll see what happens. Every chart we look at, it just says bullish, bullish, bullish. Now I want to talk about our favorite top-heavy index, the NQ, today. The bearish pattern that was developing in the NQ pretty much played out as planned. So if you look at this and you say, here's the down move, let me draw it out. This is interesting. This is symmetry at its finest. You have a down move, and then you have a bearish wedge pattern, and then you have another down move that finished right here. So how much is that against, let's say this right here? Well, it's pretty much close to the same. It's not going to be identical, but it's close enough. The point is we talked about two important levels in the NQ yesterday. The first one was 56.40, which was this low from here. This low is 56.41. I said that's going to be support for the NASDAQ, and the secondary level was down here at 55.58. Now look where the low last night was. At the same time, the S&P hit its low, the NASDAQ was hitting a low, and let me move this over so you can see it, and the low was, get out of there, and the low was 56.32, and we reversed off that and finishing the day at 57.64, over 100 handles higher. And that was a completion of the bearish pattern from a symmetrical standpoint. Pretty fascinating, isn't it? Now, I didn't talk about the XBD or broker-dealer index or the financials yesterday, and I should have, because they weren't down. And that was interesting. That was a canary in the coal mine. I just skipped over it. It was my intention to talk about them, and I forgot. However, when you look at yesterday's activity in the XBD, the fact that it wasn't down and everything else was getting killed was certainly a tell, obviously in hindsight, but it was a tell anyway. And look what happened today. We were up almost $3 on the broker-dealer index, well over 1% gain. We're above the red candle high, so there was a potential for a bearish pattern, but not really. I mean, we're above the moving averages. This is essentially was making a bullish pattern all in all, and it's playing out one more time to the upside. Higher prices are coming. Again, we've talked about this dozens and dozens of times. Without the financials, the market's not going to be able to make substantial gains on the upside. So right now, what we're starting to see and what we're seeing is a rising tide will lift all boats. Everything was up pretty much across the board today. Over in the gold market, gold was up a couple of bucks today, but at the end, my contention is that this is now making what looks to be like a bona fide bearish pattern. We have the 20 and the 50 period moving average above us, the 200 period below. We're sandwiched in between, but there's a lot of overhead resistance. And the longer this consolidates sideways, the less likely this trend line is going to be to hold. We'll see. There's no play in gold right now. I think lower prices are coming. I think we're going to edge down to the 1225 level, 1220, maybe just at 1230, something in that neighborhood. That's where I see the gold market going. That could be an intraday. We could spike that trend line and close above it. That wouldn't be so bad. That would show that the trend line is supportive of the market. But it's a little too early to make a call like that now. What we need to see is more evidence. We need to see the market just play itself out, the gold market, that is, play itself out. I think it's going to play out to the downside. There's one more leg down coming for now. That's what I believe. And then we'll see what happens after that. Right now, there's no long trade, there's no short trade. Just let it happen whichever way it wants to go. When we identify either a price pattern or either a price or a pattern that gives us an indication of what gold's going to do, then we'll be able to affect the trade. Right now, it's a bearish pattern. I would suggest the odds favor lower prices coming, but I don't think it's a short trade from here. I think what we do is just let it play out to the downside and see what happens if we can get some kind of a signal, a reversal signal, a pattern, anything of the sort. Similar routine in silver. I think what silver's trying to do right now is run up to about the $17 area. You see both the 20 and the 50 period moving average sloping down into price, and they're together basically, and I think the price or the silver market will trade up into those moving averages, at which time should find a decent level of resistance. Same routine. We're waiting for a pattern to emerge. We're waiting for a price objective to emerge. We're waiting for the market to let us know what the next likely scenario is. Just let the market tell us what its intentions are. The crude oil market, yesterday we talked about the fact that this level of 44.69 was the next area of resistance. We made it up there today. We're trading above there now. Seems to be headed for the 20 period moving average at 45.33. I think what happens from here is we pierce through the 20 period moving average. If the crude oil market can get up to $46 a barrel, I think that's a tradable level for it's a trade. It's not a long-term trade, it's a short-term trade, but it's a trade on the short side. If it gets there, it will have pierced through the 382 retrace, and that retrace would be made from this recent pivot high, this recent pivot low. A 382 is right below $46 a barrel. If we pierce through $46 a barrel, it'll satisfy the 382 retrace, and it also comes right into another consolidation area in this zone right here. Was going to, well, wrong tool, pardon me. It's going to be resistance for the market. This area right here will be resistance for the market. So you have a couple of things. You really have three things going for you at that point. You have the round number of 46, which coincides within pennies of a 382 retrace, which also coincides with a consolidation and a breakdown point. You see where the market had a big down candle here, consolidated, a bearish consolidation, a bearish wedge pattern, traded sideways, and then here's where we broke down. We're going to come back in to retest that breakdown area, which happens to be a 382 and a $46 round number. I think it's a stone cold short at that level. And by chance, if it happens tomorrow, it's even more of a stone cold short. Looking over at the 30-year bond, the bond market, the air continues to come out a little bit of the bond market. We had a severely short-term overbought condition. We're just working off some of that short-term overbought condition. See what happened here. We made an attempt to go check in at or retest the former breakout point. See this consolidation point. Here's a large up candle. We're coming down into this zone to retest that breakout point. We bounced off that today. We'll see how supportive that is for the market. I do believe there remains higher prices coming in the bond market, but there may be some more backing and filling first, but higher prices are coming. It's still bullish. It's still in an uptrend, and we respect the trend. Why? Because the trend is your friend until the very end. That's something that we never, ever want to forget. Now, the dollar came down again today, and we happened to come right into, one more time, the lower portion of our trend channel. And you guys know I am long and wrong on the dollar as it stands right now. But so far, we have yet to break the bottom portion of the trend channel. It's obviously subjective of where this actually is as we roll from one contract to another. This trend channel, adjusts a little bit here and there. It's really more for an idealized view of a trend channel. It's not necessarily meant for our purposes here to be on the penny. But nevertheless, we are on the trend channel and we are below the pivot low. So that's off the table. So that wasn't a good pivot low. And we'll just have to see where the next reversal point comes from. The next natural area of support is going to be down at 95.5. And we're just going to have to watch it. Again, I'm long and wrong. It is what it is. I think long term, from a very long term perspective, nothing has changed. But on the daily chart, it is what it is. And we're moving lower based on the euro moving higher. And, there was some comments out of the Eurozone yesterday with Mario Draghi and all this stuff about their quantitative easing and pulling back, not pulling back. I think it's all a bunch of nonsense, but at the end of the day, the dollar went down, the euro went up, I'm long the dollar, and I'm wrong the dollar for the time being. I've got time on my side, and right now I'm staying with the trade unless I'm proven wrong by trading below certain levels, which we're not really there yet. So therefore, I'm staying long, and we'll just watch it and talk about it day by day. Day by day. And with that, it's everything that I intended to discuss tonight, so I'm going to leave it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.